let's take a look at some of these EMS stocks, and they've been witnessing a downtrend for the last few sessions. Of course, barring Kaynes Tech, which is, by the way, off the high point of the day already today. The question is, what has led to this reversal? And is this simply a correction in valuations that some might have argued has been overstretched? Sharad joining in to talk about where things stand right now and the fundamentals of it. Sharad?
2 months ago, the EMS space was, of course, a darling space, but then last 2 odd months, there has been a significant correction in this space. And the question remains is this a time correction or a price correction or a combination of both? There are certain kind of points which are, giving headwinds to the counter. This is a lofty valuation that's, of course, there, but there has been a correction. Concerns are coming on the working capital front. Institutional selling was also there. We saw some blocks happening in certain counters. Brokerages are raising concern, but companies are also replying back. And interestingly, company-specific overhangs are also there. That mentioned that in their con call. But look at the peak valuation. The numbers, they are triple-digit numbers. And these are not the scores of testman batsmen, but look at that, 305x, 204x. These are the peak valuations, and see the correction which has happened. It's come down into double-digit numbers only, and it's almost 50 times for PG Electroplast and even Dixon Tech. That's 67 times. So significant valuation correction from its peak levels, and these peak levels were in 2021 and even in 2024. How has the correction been from the lifetime high levels? That's also very much important. Dixon Tech is down 26%, Amber Enterprises down 23%, and almost Kaynes Tech and PG Electroplast, they have halved when it comes to their entire share price movement. But analysts, they are bullish as well, and because of so much downtick in the prices, look at the return potentials. It's eye-watering, it seems. 12-month return potential, it's on the higher side. For Kaynes, it's 79%, so that's very much interesting. But is it the right time to find value in this space? That's a concern as well. There might be some more short-term pain going ahead, but the long-term growth story, that still remains intact. Price and time correction is likely here, and the cash flow conversion, that's one of the most important questions the street is concerned when it comes to the overall EMS space. So this is the entire setup for the EMS segment.
Okay, so I think valuation concerns and cash flow concerns predominantly there on the list of questions that maybe the street has. I'm going to take that to Renu Baid, Senior Vice President, Research at IIFL Capital, who looks at this space quite closely. Renu, great to have you on, and thank you so much for your time. Just your assessment of what you think is brewing in this entire space and why the trouble?
Well, this space has been among the high growth sectors, and especially when economy slows, growth slows, there's a bit of moderation. And market was assigning a significantly higher valuation multiple for all the companies in the space. So with the ongoing correction and consolidation in the market, we have also seen the valuation multiples for all EMS companies correcting. So which is where we have sharp correction in expectations on the stock price as well as earnings forecast on account of elevated working capital concerns or somewhere concerns on growth moderating out across some of these names.
Renu, very good morning. Alex here. So it's another case of valuations reaching a point where the room for error was wafer thin, or if at all, wafer thin, right? And so therefore the question arises is, once this correction has now taken place, a lot of these companies and the managements are very clear in the statements that they're making to say that this disruption is on account of a structural shift. And so they expect things to normalize in the fourth quarter or go back to normal in the first quarter of next year. Would you therefore utilize these opportunities to double down and buy?
Well, yes, in some names, wherever the bottom-up growth is looking fairly comforting and there is a bit more favorable risk reward, investors can now start to look at these names. So I would say, typically in the times of valuation corrections, stick with market leaders, stick with companies which have strong franchise credence and strong business models. So which is where the headroom of or margin of safety is much better in times of correction or consolidation. Which is where we have names like Dixon, Kaynes, which have strong franchise business portfolios, and we have seen both these names having a very sharp correction in absolute stock prices. And there is a good headroom to see upsides for medium to long-term investors from here on.
Renu, good morning, Neeraj here. A buy-side fund manager who came on one of our shows mentioned this, and I wonder if you you obviously would have seen through it, but I'm just trying to understand your view, that if you look at the cumulative cash flows of the last 4 or 5 years of some of the players, not all, then they are not even a whimper of the projections that these companies are making and the valuations that they are trading at. Is there a case for concern based on past evidence of operating cash flow for any of the EMS players which make their valuations concerning to you?
I would say for all the diversified EMS companies in this case, Dixon is a business model in itself, which is difficult to replicate, and they have funded the entire growth through internal accruals. So in their case, if you see the free cash flows have been healthy. In the last 2 years, obviously, when they have been investing backward as well as on the mobile smartphone side, so which has impacted FCF for them, but operationally, they are much more solid in terms of cash flows. But if you look at the other diversified names across the board, they have been consistently adding new capacities. So while operating cash flow would be there at the FCF, we don't see anything coming through because everything is reinvested back. And almost all of these names, if we see whether it has been Kaynes, Sirma, they have been there in the market every 1 to 2 years to raise equity to drive or to get funds for their growth. So whether it is for organic growth, core EMS business, working capital repayment, or to fund diversification like OSAT PCBs. So to that extent, they would need growth capital if they have to grow at 35-40% kind of CAGR growth rates, because there's a continuous requirement to reinvest back in new capacities and growth initiatives. So either we see somewhere growth consolidating for them and a phase where the operating cash flow is then plowed back, at least for the sector and space, which is still early in terms of saying maturity in terms of growth rate. There would be continuous investments in capacity which is required. So free cash for these companies or companies in these sectors typically tend to be much more softer. And that is pretty much standard across the board.
Okay, your top pick in this space, Renu? What would be your pecking order?
Yeah, our pecking order after the recent correction, we like Dixon, Kaynes in the space. Sirma also on a risk-reward basis looks comfortable to us. But clearly, after the recent sharp correction in Kaynes, we think valuation multiples now in a much more comforting zone compared to earlier. And even if we have recently downgraded our revenue forecast by 20% for 27-28 for Kaynes, assuming that the growth will moderate a bit in light of working capital concerns and slowdown that they are targeting consciously in the metering space. Pursuant to that, we still think after the recent correction, stock provides headroom for anywhere between 40 to 50% upside from these levels.
Correction in Kaynes, even today, it's come off its highs right from the morning as well. Renu, thank you so much for joining us on that.